It's time for Yahoo Finance's Market Minute. Stocks are selling off today, coming off of their worst week since September. Redfin shares surging on news. Rocket plans to buy the digital real estate brokerage for $12.50 per share in an all-stock transaction that values Redfin at about $1.75 billion. Rocket ticking lower. Danish drug maker Novo Nordisk is under pressure on disappointing results for its next-generation weight loss drug. Trial participants in the new drug lost just over 15% of their weight compared to over 20% for Wegovy. And Tesla is lower today after its China shipments slid for the fifth consecutive month. Shipments in China fell 49% in February from a year ago to the lowest level since July 2022. That's according to China's Passenger Car Association. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, is being a stock picker the best way to get returns in the current market? I speak to a portfolio manager about investing amid uncertainty. And China's retaliatory tariffs on U.S. farm products that begins today. I'll speak to the CEO of the U.S. Soybean Expert Council about the impact that these policies could have on your food prices. Plus, it's tax week on Wealth. All week, we'll be covering everything that you need to know ahead of the April 15th tax deadline. And today, it's all about side hustles. We'll get you all the tips that you need to navigate how taxes are changing for gig workers later on in the hour. All that and much more coming up. But first, let's take a look at some of the market action here on the day. We are 90 minutes into the start of today's trading activity, and stocks continuing to sell off amid growing recession fears on Wall Street. All three major averages down. The NASDAQ is down 3% right now. Joining me now, we've got Joanne Feeney, Advisors Capital Management Partner and Portfolio Manager. Joanne, your piece of advice right now is to avoid exposure to the market and instead find select stocks with a better value or more robust growth potential. And there might be some people out there that are scratching their heads. Just break down what that means.
Yeah, good morning, Brad. Obviously, this is a degree of volatility that a lot of folks may not have seen before, and there's good reason for it. There's a lot of uncertainty. In fact, measures of policy uncertainty are the highest they've been since the great financial crisis and since the dot-com bubble burst. So we're in an unprecedented space for a lot of investors, and so we're a little bit concerned here about what the market overall might do because, first of all, it is so weighted heavily towards those Mag 7, towards the top 10 stocks in the market, making up such a big part of the S&P 500. And we do see a lot of potential headwinds coming from the tariff policy side. We just don't know yet how that's going to play out, and we don't know how companies are going to react to that. But in the meantime, there are some really strong growth dynamics at play related to the generative AI area and some other related spaces. So hope is not lost, but one does need to be selective.
And so, as you're being selective, what are those picks that you're kind of leaning into? As we've heard even some investment strategists and portfolio managers talk about this period as the great rotation. Where would you be rotating into? What are some of the kind of top strategies you're employing?
Brad, it really depends on what your goals are and your time horizon. If you've got a sufficiently long time horizon, then what you're seeing right now is an opportunity because we do think that the strong growth potential, fundamental growth potential coming out of AI is one that's going to last for years. So companies that have sold off recently, whether it's Broadcom that had a terrific earnings report last Thursday night, or NVIDIA, or some of the related stocks like AMD and even the semiconductor capital equipment companies who are right in the crosshairs of some of this tariff uncertainty. Really, for the long run, these are going to be integral parts of the growth story, both here and around the world. So those are places where one could start to build a position sufficient, so long as the investor has a sufficiently long time horizon. To worry about, some of the near-term risks and maybe to defend against that, you have to go into things that some might call a little bit more more boring, whether it's a Bristol Myers or an AbbVie or a TJ Maxx, which we think would hold up if we do end up in a recession. That's not our base case at the moment, but it's really going to depend on how the tariff policy plays out, or even in the utility space at Duke Energy. So there are places to go. High quality companies with strong balance sheets are the places to look, and companies in the healthcare sector with strong drug pipelines. Drugs, given our demographics in this country and around the world, are going to see increasing demand. So go where structural growth is and find some opportunities now, and there are plenty of them given how much the market is, particular areas have sold off.
Earlier today, we spoke to Mohammed El-Arian, who's the president of Queens College, Cambridge, about the strategy for retail investors. I want to play a clip of what he had to say and then get your reaction as well on the other side.
For a small investor, the most important question to ask yourself is, what mistake can I not afford to make? When the world is really uncertain, the probability of a mistake goes up. The biggest mistake an investor can make is to be forced out of a good position by high volatility. So it's really important for small investors to understand their appetite for volatility, because we're going to have a lot of volatility going ahead. If you are a large institutional investor with the whole range of tools, then you can make volatility your friend.
And so, Joanne, I wanted to ask this question with the mindset of a lot of small investors out there. They might look at what Warren Buffett is doing and say, if he's sitting on this much cash, then maybe I should be too. But there's also the thought process of, okay, where is a person like Warren Buffett or some of the biggest power money out there still holding on to positions? And to Mohammed's point, understanding which positions you shouldn't have to be forced to exit. Which positions from your evaluation would that look like?
What Mohammed said speaks to the question of time horizon. If you can afford to dedicate some of your investment dollars to stocks and do it for the long run, then you won't need to be forced out of anything. Then you could take advantage of buying some of these things that have sold off. But if you're saying, oh, I can only afford to invest, for the next year, but then I'm going to need the cash to buy a house, you do not want to go into these riskier positions, because volatility clearly looks like it's going to stay high for quite a while. And so when you need that cash, the last thing you want is to be forced into a situation where you have to sell something that's down a lot. So if your time horizon is short, you want to stay in stocks that have much more resilient earnings, even in the midst of tariffs or in the midst of potentially an economic downturn. Those are the companies I mentioned before. A company like TJ Maxx does well, even if there's a downturn. Duke Energy, Agilent or a Bristol Myers. These are companies that have strong end markets that are less likely to be sensitive to some of the policy disruptions that could be coming down the pipeline.
Joanne, always a pleasure to grab some time with you. Thanks so much. Bitcoin below $80,000 today after President Trump signed an executive order creating a strategic Bitcoin reserve for the United States. Yahoo Finance's Josh Lipton here now with the biggest takeaways from the White House's first ever crypto summit.
Brad, America will be the Bitcoin superpower of the world. That is what President Trump said at that crypto summit at the White House late last week. Now, that gathering took place, of course, after the president made good on a promise he made to the crypto industry. He authorized the creation of that strategic Bitcoin reserve and a separate U.S. stockpile of other digital assets. One of the attendees at that summit was Coinbase CEO Brian Armstrong. He told Yahoo Finance's Jennifer Schonberger that the president had, in his words, breathed life back into this industry, and said his company did plan to hire around 1,000 people in the U.S. as a result of the increased regulatory clarity provided by this new administration.
If the United States government is now a holder of Bitcoin, maybe a buyer of Bitcoin in a budget neutral way that won't cost the taxpayer anything, I think the rest of the G20 are going to see that as a signal that Bitcoin is really the successor to the gold standard, and maybe the rest of the G20 should also hold a strategic Bitcoin reserve.
Now, David Sachs, Trump's crypto czar, said on X that this new Bitcoin reserve will be seeded with Bitcoin already owned by the federal government that was taken as part of criminal or civil asset forfeiture proceedings. This means it will not cost taxpayers a dime, Sachs said. He noted the U.S. government owns an estimated 200,000 Bitcoins and said the U.S. will not sell any Bitcoin once it is in the reserve. Now, one open question, though, is whether the reserve is going to be used to buy more Bitcoin beyond the assets already held by the U.S. government. SAC saying the Secretaries of Treasury and Commerce do have the authorization to develop budget-neutral strategies for acquiring additional Bitcoin, provided that those strategies have no incremental costs on taxpayers. All of this news coming as Bitcoin has been making big moves. It surged nearly 60% over the 6 weeks following Trump's win back in November, eventually hitting that record of more than 109,000 on January 20th. But then the slump started and has fallen sharply here. It's now down about 25% from that all-time high, Brad.
All right, Josh, a lot to continue to track here going forward for BTC, USD, and all of the other cryptocurrencies too. Thanks, Josh.
You got it.
Now time for some of today's trending tickers that we're tracking. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got the Catalyst co-host, Madison Mills. And Maddie, first up, we got to talk a little Dollar General. Shares are ticking higher today. Likely investors anticipating its earnings out on Thursday. Investors hoping for some brighter signals from the consumer following a rough earnings season so far. But perhaps more fun to talk about, and it's something that I saw across the wires here this morning. Dollar General, a new collection with legendary country star Dolly Parton. Maddie, we know that she's had a lot of efforts to make sure that she's putting affordable products out there into the market for consumers, really pointing back to her own upbringing as she's talked about in the past as well.
I mean, this is going to get me into a Dollar General. I got a Google Maps where one is in proximity to the Upper West Side. But hey, I mean, I'll get a Dolly product. You know, I was joking with you beforehand of this is a move off of, you know, a run up into earnings, not necessarily the Dolly collection, but who knows? Maybe investors are really excited about the collection, which, by the way, everything, if I'm reading this correctly, is under $10. It's going to be at 20,000 locations across the country here, mostly kitchenware, household items, in line with Dolly Parton's general collections that we have seen in the past, being more houseware related, coming out for spring here. But as you mentioned, Brad, it's going to be a really interesting tell about the health of the consumer. And interesting to see if Dollar General's earnings are extremely successful, does that tell us that there actually is a challenged consumer backdrop where consumers are trading down, looking at Dollar General as a place to continue their shopping? In the past, what we've seen is that if there is too much slowing in the economy, Dollar General actually struggles because that lower income consumer pulls back on their shopping entirely, and we see them really switching to only staples for their purchases. So definitely a key earnings print to watch.
Yeah, you make a great point, and it's something that we've heard from a lot of economists too, because we tend to paint this broad brush about the consumer, but as you think about the different consumer groups and income levels, lower income households have felt like they've been under a recession probably for the better part of a year and change now. And so that's something that's come up time and time again, even for some of the executives that comment on the state of the consumer and being careful not to just paint it all as just one big consumer group. There are certainly bifurcations within there in a major way. Absolutely. Also, we're tracking Coinbase here. Coinbase under pressure amid some disappointment that the stock was not included in the new batch of tickers being added to the S&P 500 index. Barclays had previously identified Coinbase as a potential candidate for the index before the reshuffling here. Of course, DoorDash, Williams-Sonoma, and TKO, they are the three names that will begin trading on the S&P 500 starting March 24th here. And there you're seeing those names in kind of symphony with the rest of the markets moving lower here today.
That's exactly what I was just going to say, is that I think part of the selling that we are seeing right now in Coinbase mirrors a sell-off that we're seeing in crypto stocks. It's also got the additional pressure of the sell-off in the S&P 500. And then, yes, specific to Coinbase, that they were not included. They didn't make the cut for the S&P 500. But I do just want to mention that we're really seeing selling here across the board when it comes to the market. Only a couple of sectors getting some reprieves today as we do see this sell-off. But crypto in particular having a tough moment. Bitcoin moving to the downside today. You've got all of these crypto stocks that are under pressure, the likes of Robinhood, Marathon, MicroStrategy, because we didn't really get any of those positive headlines to come from the White House Crypto Summit on Friday. It was a closed-door meeting. Our own Jennifer Schomburger was able to speak with CEO Brian Armstrong, who was in that meeting, but there wasn't some huge announcement of government funding for the strategic Bitcoin reserve, for example, which was something that investors had been bullish on. So it'll be interesting to see if something can turn around some of the selling that we're seeing in crypto assets.
Yeah, in the interim period of time, still you can't sit with us story for Coinbase and the S&P 500.
Absolutely.
Maddie, thanks so much.
Thank you, Brad.
Coming up, 2 years after the Silicone Valley Bank collapse, are regional banks in good shape? We'll discuss with the former CEO next. Today marks 2 years since Silicon Valley Bank's collapse sparked a mini crisis in the regional banking sector. But just last week, financial stocks saw their worst session since the collapse. So how safe are banks in the current economic backdrop? Joining me now, we've got Ken Wilcox, who is the former Silicon Valley Bank CEO from 2001 to 2011 and author of the China Business Conundrum. Great to have you here in studio with us.
Well, thank you so much.
So let's dive into this a little bit, because I think more generally and broadly here, 2 years since the Silicon Valley Bank collapse hit financials, how is the financial sector now in those lessons learned, the recovery, and now the outlook for the future?
I think the financial sector is doing just fine. I think it's in better shape than it was. And as far as I can tell, the future is reasonably bright.
And so within that, what are the red flags that we should be looking out for to make sure that if there is ever another event like Silicon Valley Bank brewing, how we would be able to anticipate it?
You know, that's a difficult question, because I will admit that I had absolutely no idea that this was brewing at Silicon Valley Bank. I was in North Carolina visiting my son in the Marine Corps at the time, and I picked up the newspaper, figuratively, obviously online, and I almost fell off my chair. I did not expect that at all. So I spent a lot of time looking back and trying to figure it out. It could have been anticipated, but it would have required, I think, a financially astute observer, and they would have had to study the financial statements. And the financial statements were available. I think the key there would have been noticing two different things. One was, in the course of 21 and 22, a rise in deposits. Number two, a rise in the bank's investments in long-term interest-bearing securities. And number three, a rise in interest rates. And if a financially astute observer had been looking at those things, which were all available,
right,
they could have figured it out. And
so with that in mind, are there any of the similar instances of banks right now where because those financial statements are also available, is that kind of taking place at any of the other institutions from what you can measure at this point?
Well, to a certain extent, yes, but I think that those other institutions have taken precautions in the meantime in one form or another. So I don't see anything that's likely to blow up at any time in the near future. I'm just saying that in that particular case,
sure,
I was not in a position to figure it out.
And so all of this in mind, it was a larger, not just campaign, but also a larger messaging that we were seeing from the financial services sector to remind consumers about the safety of the banking system. How successful has that been? Has it been successful? And our regional banks, the ones that are able to operate in any environment, and especially in this environment, does it seem like they have proven to consumers that they are safe to continue to transact with?
I think so. I think in a general sense that's true. I would also like to insert here, just to be clear, in Silicon Valley Bank's case, it was not the business model. It was a big error made on the part of what I'd call the Treasury, the CFO, in terms of taking excess deposits and investing in long-term interest-bearing securities. But in general, I think the financial sector has learned a lesson, and for the time being anyway, is taking the necessary precautions. That said, I think consumers need to always be ever alert. They need to do their best, become financially sophisticated. They need to listen to folks like you here on Yahoo Finance, and they've got to just keep reading and questioning.
Yeah. And so with that in mind, what should the average consumer or average bank customer know watching and being a part of the system that's playing out here in 2025, if they are kind of going down their checklist of how to make sure that they're managing finances and making apt money decisions, knowing how the banks themselves are navigating what is a quickly fast-paced and changing environment, both geopolitically as well as for their businesses?
Well, I think, first of all, if you're talking about the average consumer doesn't have enough money in the bank to spend that much time worrying about it, nor do they have a lot of excess time to become financial experts. I think where this plays a real role are in situations that I sometimes see now in my current role, advising some charitable organizations. And what happens there is a charitable organization has a bank account that's bigger than an average consumer, but not gigantic like a corporate company would have. And they're wondering, where should we put this money? And they seem to, and this is something I've encountered more than once now, they seem to see a trade-off between being with a big bank, which probably is strong enough and stable enough that could weather almost any storm, and on the other hand, being with a small bank where they feel they'll get more attention, maybe a higher level of customer service because they're not that big to begin with. And those people, I think, would be well served to pay attention to reports that are issued by places like Weiss and Bauer, maybe Keefe Bruyette would and read those reports.
Yeah.
And reading those reports will tell them what they need to know.
Ken, just lastly, while we have you here, we were talking in the break about your book that's out, and congratulations on it as well here, The China Business Conundrum. As you look across what's playing out within the tariff tit for tat and geopolitical landscape, what more extremely are you monitoring at this juncture?
Yeah, with respect to the geopolitical landscape, that's a very, very tough one because we have, on the one hand, our new president, and on the other hand, we have Xi Jinping. And I would say that China likes our new president for a couple of different reasons and is not that favorably disposed toward him for a couple of other different reasons. On the negative side, they think he's very volatile, unpredictable, and prone to a lot of drama. And on the positive side, they think that he's a businessman and that he will engage in deal doing. And they're looking for an opportunity to do deals.
Interesting.
Trade-offs.
Right.
You do this for me, I'll do this for you.
Certainly. Ken, thanks so much for taking the time here with us today. Really appreciate it.
Thank you very much. Let me just say one more sentence, and that is, I wish SVB all the best. They're good people.
We appreciate it, Ken.
Thank you.
Thank you. And let's get a quick check on the markets. Sell-off deepening on Wall Street. The NASDAQ down more than 3%. Coming up, I speak to an expert about how retaliatory tariffs from China could impact farmers and consumers. That's coming up. We are 2 hours into today's trading activity here, and the S&P 500 is down roughly 2% here. Let's take a look at some of the sector activity, really give you some color around what is transpiring at this moment. Technology is the biggest laggard. XLK, the sector, you're seeing technology down by about 3.6% here. And then some of the defensive plays you're seeing holding up steady right now. Energy's up 1.8%. Staples also up by about 1.2%. Utilities seeing fractional gains there. And I could go on, but to dive further into what is exactly playing out within the technology sector, perhaps let's take a look at the NASDAQ 100, where you can see some of that lake red, and we'll call these, as of right now, the maroon 5, if you will. Apple, Microsoft, NVIDIA, Alphabet or Google, and Meta, they're all down deep, and all of them right now sitting at about 5% in declines, roughly there. Microsoft 3% in declines, and NVIDIA and Google in that range here. You're also seeing Tesla take a big hit on the chin today. Right now, it's down by about 8.5%. Let's put this in a year-to-date context as well for what's transpired. Tesla shares are down 40% during 2025 here. We're continuing to watch some of that slippage. Palantir, too, you're seeing a deep pullback ultimately on the day. That's down by about 6.3%. Still holding on to gains of about 5% over the course of the year to date, but a lot of that slippage certainly has come over the last, let's call it 2 weeks here. I'm trying to give us a good kind of month-to-date view. I believe we had one on here. But anyway, I'll put this on a 3-month view just so we can see, and that's basically somewhere within that year-to-date range. But all those things considered, taking a look at the Dow, and the 30 components there. You got still a few spots of green, and let's take a look at the equal view. So kind of split for the 30 Dow components here. Apple, though, that is the worst of the performers. Amgen, that's holding up, and it's higher by about 2.8, 2.9% right now. China begins imposing tariffs on U.S. farm products today. The policies include a 15% tariff on chicken, wheat, and corn, as well as 10% on products like soybeans, pork, beef, and fruit. China is the #1 importer of U.S. soybean products, and soy exports are a major part of the U.S. economy. It's America's #1 agricultural export, adding $3.12 billion to the U.S. economy in 2023, according to the U.S. Soybean Export Council. So, how will these tariffs impact American businesses and consumers? Joining me now is Jim Sutter. He is the CEO of the U.S. Soybean Export Council. Jim, thank you so much for taking the time here with us. Just walk us through your thought process that you are kind of rolling out for the organization, for the team as well, as you're monitoring all of the tariff talk that's taking place.
Yeah, thank you very much, Brad. Appreciate the opportunity to talk with you. And it's certainly not what we would want to see happen. This is not our first choice. You know, we have been working in China for 43 years now. Our organization, U.S. Soy Farmers, working together with USDA's Foreign Agricultural Service, recognized early on, back in the 1980s, that China was going to grow to be a very important market. And wow, did it. You know, it has grown to be the biggest importer of soy in the world. And also the biggest, as you rightly said, is the #1 customer for U.S. soy exports. So we are hopeful that this will be a short-lived situation. You know, back in 2020, January 15th of 2020, the United States and China, with great fanfare, President Trump and President Xi and their administrations negotiated the Phase 1 agreement. And it contained a lot of really good things that were going to be done, both on a pure trade perspective, but also in terms of easing lots of regulatory restrictions. It started doing that, but then COVID hit. And then we changed administrations, and it sort of lost its focus. So what we would hope is that the situation we find ourselves in today, which isn't exactly what we want, but hopefully we will be able to quickly get back to a new and improved Phase 1 or a Phase 2 agreement, which includes many of those same things that were negotiated before, and allows the two countries to get back to a solid trading relationship.
Jim, after there is an agreement, how quickly do we see some of the action that takes place from purchasing?
Well, the last time an agreement was signed, back when I mentioned in 2020, it happened almost immediately. We saw Chinese companies start to purchase U.S. soybeans, and prices kind of rallied very, very quickly. This time, we've already seen the expectation of tariffs have had somewhat of a negative aspect on prices. I mean, prices are relatively low for U.S. soy because we had a record crop here in the U.S. last year. There's a very big crop growing in South America. We are sort of a global crop, so we depend upon the global supply and demand. So we have prices at attractive levels for consumers already. So we don't really want prices to go down any further.
And so all of these things in mind, what is the time span that you're monitoring for how this plays out to the point where it would materially impact not just this year's results, but also for companies that are operating and rely on some of these partnerships internationally for soybeans specifically, and other commodities perhaps, that it would impact their ability for operations in the future as well?
Sure, that's a great question, Brad. And the most important thing we're looking at is how quickly can some sort of an agreement be reached? And particularly important for us, the timeline we're looking for is when the crop would be harvested in the United States. Now, we haven't even planted it yet, so there's quite a bit of time. There's probably about 6 months. So we would hope that certainly there could be some sort of a new agreement in place by the 1st of October. And that's really the time when U.S. soy exports would start flowing in style to China. In the meantime, China tends to import a lot of their soy at this time of year from South America because we have the two hemispheres that harvest the crops and they kind of switch back and forth. But what we'll also see, I think, is other countries, because U.S. prices have come down in reaction to this tariff talk, I think we'll perhaps see a little bit of an uptick in demand from other countries that will say, hey, U.S. soy's on sale. So they'll want to come and make some more purchases. So we're trying to find the best solution we can out of all of these sort of things.
Jim, lastly, while we have you, of course, consumers are watching this and saying, yeah, but what does this mean for the prices that I'm paying when I'm filling up the basket and my weekly or cyclical purchases, as they're just trying to fill up the pantry or refrigerator?
Yeah, again, that's a good question. And we have to talk about two different sets of consumers. The last time that this happened, it was quite bad for Chinese consumers because the price they started paying for soy imports, which is a very important feed ingredient for their pork industry and their poultry industry, really went up because they weren't importing anything from the U.S. Likewise, for U.S. consumers, those prices went down some. So if anything, it should help make U.S. products here in the United States even more competitive. Now, I think our prices are already plenty low, so it's not feed ingredients. If there are prices that are high today, and I think everybody thinks of eggs being the high-priced item, it is certainly not the price of soybean meal or corn that is driving the high price of eggs. It is the shortage we have because of the avian influenza. But raw materials shouldn't be the problem. And if anything, with their low prices today, it should be helping U.S. consumers.
Jim Sutter, thanks so much for taking the time breaking this down with us.
Thank you, Brad. Appreciate it.
Coming up, we're breaking down what will happen when student loan defaults hit borrowers' credit scores. We've got more on wealth after the break. On March 7th, President Trump signed an executive order limiting eligibility for public service student loan forgiveness. While the president did not name specific organizations, he did cite so-called activist groups, as well as calling for stricter enforcement of on-time payments before forgiveness eligibility. This comes as President Biden's SAVE plan remains blocked by the courts, with millions of borrowers currently in forbearance as they await final decisions from the Supreme Court. And a new study from VantageScore found that there are 9 million borrowers who are currently behind on payments. That's over 40% of borrowers with payments due. Joining me now in studio is the author of the study, Ricard Bandebo, who is the VantageScore chief economist. Great to have you here, and thanks for taking the time.
Thank you. Delighted to be here again.
Let's dive into some of the findings here. How much could this impact students' credit scores as well?
So the impact is really twofold. One, on the borrowers themselves, and then secondly, on the population as a whole. So on the borrowers, what we're seeing is that they're going to see quite significant decreasing pressure on their scores. So for instance, someone who has a high score, let's say they have a VantageScore super prime score of like 800, they could see their score drop by as much as 129 points.
And so all of this in mind, some of the downstream effects of a lower credit score, how that could impact future home purchases, being able to access any type of capital. What are the kind of longer term ramifications of this?
So what's important to bear in mind is that a credit score is a bit like reputation. Mm-hmm. It takes a long time to build, but it can fall very quickly. And so a delinquency, like a student loan delinquency, will sit on the file for 7 years. So it takes a long time to repair this. And so the consequences of that is that you may no longer be eligible for certain types of products that you wanted to buy, whether you wanted to get that car and get an auto loan, or it may well put off a lot of people's ability to buy their first home. And so, but then as we look at the population as a whole, it has an impact on consumer health this year. And so that's also not negligible.
Did you find any positive signs among students who are likely to be current on payments?
Yes, so those students who have been making payments, which is the majority, they've seen their credit scores go up by, on about 8 points or so. Oh. So that's been very positive.
Nearly half of defaulting borrowers had either prime or near prime loans. What does that tell you?
Well, so student loan borrowers are often earlier on in their financial history, right? So they tend not to be as many of them in prime or super prime as you would have see somebody from Gen X or someone else. So this is definitely a phenomenon that's having a bigger impact on some of the younger generations, such as millennials and Gen Z.
And so as we're awaiting for SCOTUS's ruling on some of the existing plans that the previous administration had put forward, what are we seeing from now, the current Trump administration, that gives us a sense of how student loans will be approached over these next 4 years, or even programs for students who are looking for some type of debt relief?
I think it's still early days. I mean, what we're seeing now is that 9.2 million, those were people that were due to come in based on actions made by the previous administration. Now the SAVE program, there's another 8 million, roughly, student loan borrowers that fall into that 8 million. And so we're likely to see the impact of them later on. So probably in the second half of this year, we'll see even more delinquencies coming from those people who were in the SAVE program.
Are there ways that you can maintain and even build your credit score, even knowing that you might have to make that call into your student loan servicer and say, hey, I know I'm a little bit behind, but I want to make sure that this doesn't ding my credit score for a long period of time?
For sure. I mean, the best thing that a lot of borrowers can do is to get hold of their student loan servicers right now and try to intervene. Either A, make a payment, or B, see if they can negotiate some form of plan or something along those lines. Because still, the majority haven't yet been reported. So we started seeing them trickling in already, but it's going to take several months for all of this to cascade through onto the credit file. So for the most people out there, they still have a chance to do something about it.
Rickard, great to see you again. Thanks so much.
Great to see you.
A brief programming note on today's episode of Financial Freestyle. Host Ross Mack spoke with the CEO of the nonprofit Chicago Scholars, which helps prepare kids for their future careers using AI. Take a listen.
One of the things I recognize the nonprofit sector as it's currently built and defined isn't scalable anymore. Like really doing true work that's like national and not just in particular parts of regions required a solution that's not going to be boots on the ground. First, it costs too much money to do what we do. Chicago Scholars is a $9 million nonprofit where our cost per child over our 7-year model is about $10,000 a student, $1,000, $1,500 a year. So if I wanted to replicate that across the country, you're talking a few $100 million I'd need to raise to do that. So I put my tech hat back on and said, why not build a platform and use technology to democratize access to basically what is an online career counselor for young people anytime, anywhere.
Catch all new episodes of Financial Freestyle every Monday, 12 p.m. Eastern on Yahoo Finance or wherever you get your podcasts. Coming up, tax challenges for millions of Americans with a side hustle. We have everything that you need to know before you file and some tricks that could save you money. That's next on Wealth. It is tax week on Wealth, and all week we'll be covering everything that you need to know ahead of the April 15th tax deadline and what you can still do before you file. And today, we're focusing on some side hustles out there. According to a 2024 Bankrate survey, 36% of U.S. adults earn extra income through a side hustle. Now, the IRS is cracking down on unreported online income, and that means big changes for millions of Americans. Here with me to help, we've got Carla Dennis, KDA Inc. CEO and founder. Great to have you here in studio with us, all the way from California.
Yes, thank you for having me.
Let's dive into this. What are the big changes for side hustles this year?
Yeah, so this year, IRS is requiring the merchant vendors like Yale and different things like that to actually send to side hustle people a 1099-K. That means that if they have any income over $600, they are now going to get a 1099 form. That's going to be different as opposed to last year, you had to make over $20,000 and 200 transactions.
That's a drastic difference for a lot of people.
Drastic change.
And so as we're thinking about some of the expenses, say you have a side hustle, say you're a freelancer as well, what are the expenses that freelancers can deduct to lower their taxable income?
Well, I think one thing that's really important is freelancers need to realize that they're really in business. So they can take any expense that they incur to generate that income. And some of the expenses that they can incur would be like their car expenses, their cell phone expenses, home office expenses, things that they might not even think about, computers, internet, anything a normal business owner would take.
And so what tips do you have for people with a side hustle before they file?
One of the things that they should do before they file is realize all those personal expenses that they're using for business, transition over and start actually taking it as a business deduction. Things like their car, their cell phone, things they're paying out of pocket, their meals, their travel, they should definitely take that now as business. In addition to that, they want to have a separate bank account for their business. Don't commingle funds, because when you commingle funds, IRS can classify those expenses as personal. and you could lose those deductions.
No, that's a great point, to make sure that you don't trigger any red flags with the IRS. None of us want to do that. And so as we're thinking about why some of the drastic changes have taken place, I mean, we're talking about going from $20,000 as the threshold to $600,000. Why do you think that is, and how many more people does this potentially impact and bring into this?
Yeah, I think because our government is looking for opportunities to generate revenue. That's the IRS's entire purpose, is to get revenue for the government. So many people, especially during COVID, created side hustles, created these businesses, and they know that there's a lot of unreported income going on. So IRS is looking to crack down, get all the income reported, and making sure they collect the appropriate amount of tax.
Very valuable tips. Carla, thanks so much for taking the time here with us today. Really appreciate it. According to the investment company Institute, 70 million Americans have 401k accounts, and the majority save through work-sponsored plans, but there's also millions who save for retirement on their own, and the deadline to make 2024 contributions, that's coming up April 15th. So here to tell us some of their options to save and avoid fees while they do it, we've got Yahoo Finance senior columnist Carrie Hannon. Hey, Carrie.
Hey, good morning, Brad. Yeah, I mean, this is roughly half of American workers do not have an employer-provided retirement plan. And these can be people working side gigs, side hustles, freelancers, people working for a small business that doesn't have a plan. So it's really do-it-yourself retirement, and this is super hard to do. I mean, trust me, I've had to go through this, and every dollar you make, you're like, I can't possibly set aside for retirement. I need this for cash flow. But here we come up to April 15th deadline, and this is when your accountant or when you're doing your own taxes, you realize how much your total income was, and you figure out what you can set aside by the filing date, by April 15th. So you have a couple of options here. Now, you can do a traditional IRA. You can do a Roth IRA. You can do, if you've already set it up last year, a solo 401k. You have to have had that set up by December, the end of December 2024. Your health savings account is another great way to do that. And also within IRAs, there's something called a SEP IRA, which gives you even more to set aside. So the range is $7,000 for your traditional IRA and your Roth. To the 401k is a lot more. It can be up to 25% of your income even. And if you're over 50, you can jump in another $1,000 for your IRA. This is really important because it takes, if you do the traditional or the 401k, it's right off your tax bill, same with HSA. And I think that's super important. It takes diligence. It takes discipline. You have to do this, and it's super important, and it lets it go. But let me give you a little advice for anyone who's going, oh my gosh, okay, now I know I have this much money I can set aside and chop down my tax bill a bit here. What do I invest in? And it's very easy to set these accounts up at a credit union, at a mutual fund company, at a bank. Super simple. They make it easy to set up these IRA accounts, and you just shift the money from your bank account over to it. But the important thing, Brad, to look for is expenses. I'm a big fan of index funds and target date investment funds, which tend to have lower expenses. The two of them, the target will give you a nice broad diversification. You don't have to have huge sums of money to get these things set up. But look for low expenses. And what I mean by low expenses is anything under 0.10% is considered low. You can find that right on the profile of the mutual fund company. Vanguard recently just slashed a bunch of their fees for their mutual funds to 0.07%. So by all means, if you're shopping to make this investment for your retirement account, for your April 15th deadline, please look at expenses because they may seem small to you right now, but they have an outsized impact on your retirement savings over time because it whittles away each year that account will get that expense hit. So good luck to everyone, but please make yourself do that because it's super important.
Carrie, thanks so much. Really appreciate it. Everyone, let's do a quick final check of the markets here as we're taking a look at the major averages. We've seen some continued slippage during today's trading activity. Taking a look just briefly at the Dow, the S&P 500, and the NASDAQ. The NASDAQ is down a little more than 3% right now. Thanks for watching Wealth.